silver is one of these deals where you can see that the chess pieces are put on the board. And when we talk about a cup and handle formation, it mimics gold's cup and handle formation almost perfectly, with the exception of gold has broken through the base or the top of the cup and has gone up to the handle. And what we see with silver, it's right at the base, right at the tip of the cup, ready to break through. If it gets through 35, in essence, it's broken through to the handle part. And this is a long 14, 15, 16 year base building. That makes the move that much, potentially that much stronger. You can feel it. And the ability of the West to silly as it may seem, suppress the price of silver nakedly, if that's a word, or the naked suppression, is very dangerous right now when we see these deliveries and the amount of standing delivery requests, not just on COMEX, but we're seeing it the same way on the Shanghai Exchange. We're seeing it on the London Metals Exchange. When we see stuff come off Shanghai, it's that they're promoting and prompting their citizens through state-sponsored gold and silver acquisition programs to accumulate metal. In fact, just as a side note, we just saw that China has lifted quotas and increased them for the banks. The banks who are traditionally the ones importing the metal into the country, they've now increased those quotas, and we're seeing large amounts of importing coming into China. I think I have the amount. Let me just see if I do. I may or I may not. I read it the other day. I thought I jotted it down. I may not have. But huge amounts of gold and silver delivered into China. Here we go. Well, for gold, they bought 30 tons of gold in March, five times more than they officially reported, according to Goldman Sachs. This follows the purchase of 50 tons of gold in February, 10 times more than they reported, according to Goldman Sachs, and 127.5 tons in April. Well, we know that they're importing gold. The rumor is, according to Eric Young, King Kong on X, that they're buying up every ounce of silver that's not nailed down. And that's one of the reasons they're going to lengths to buy doré and concentrate, which disintermediates the market, which makes it impossible for us to say just how much silver they're really buying. But ask yourself, if a $33, $34 price was real in terms of its value, why would they be going to such great lengths? Eric says they're buying up everything they can, playing the long game. Hold tight, all you silver stackers. We will have our day, is more or less what Eric is saying. And I agree with that. So silver is finally starting, I think, to get noticed, and even noticed by the central banks and the big traders, it appears. So, we've been waiting a long time for it, whether it be the technical formation, the amount of deliveries, or the central bank purchasing. All three things are at the highest level, point to silver finally starting perhaps to get that big push above 35 into the 40s. And from there, it's really, there's very little of any resistance above that, potentially off to the races. And it's crazy with gold at 33.80, the 200-year average roughly of even 45 to 1 would put silver conservatively at $75 an ounce. And that would just be the average price of literally last 150, 200 years. It's coming out of the ground at 6 to 1, which would put it at near $400 an ounce. So I'm not saying we're going to be there tomorrow. But what I am saying is, from an asymmetrical standpoint, not only have all of us realized what a value silver is, no matter how difficult it is to hang on to that conviction in the light of counterintuitive market behavior, it appears to me that the most sophisticated and well-informed traders in the world are now onto that same thread. And so I would expect, based upon the positioning, the deliveries, right now, the 36.36 closing price yesterday in Shanghai, the arbitrage, everything is pointing towards an escalating silver price into the fall. We already know how the world feels about accumulating gold in this environment. I think silver is not too far behind it. And that's the pattern it's followed for all of time. There's a 90% correlation in their movement, but not always with perfect symmetry. And to Rick's point, silver goes first, silver catches on. And it appears that we're right at that level, right at the time when a lot of the retail investors have, kind of lost faith in silver. And I understand that. And quite frankly, that's a compliment, if you will, to the manipulators who have done a very good job not only through volatility, but through counterintuitive price action. And by holding it down in the face of gold, accentuating, there's been a lot of people who are just exasperated with silver. And that is another contrarian indicator. When they've held for this long, they see things brewing and growing and accentuating, and just through exasperation and just being exhausted by trying to stay positive and focused, they give up. So yeah, I honestly am quite bullish on silver, maybe more so than I've been in a while, just looking at what's hiding very, very near the surface, but yet just a little bit under the surface, so it's not getting much in the way of attention.
All right, folks, settle in, because by the end of this conversation, I think you're going to see why I have more conviction today, right now, than maybe at any point in my entire 35-year career in this industry. And that's saying something, because I've watched precious metals move through cycles of outright manipulation, complacency, massive global realignment, and ultimately through windows of opportunity so glaring it almost baffles me. More people aren't paying attention. Let me start by saying this straight out. Silver today is the most asymmetric asset on the planet. When I use that word asymmetric, I'm talking about something that has limited downside and potentially generational upside. That's not hyperbole. That's looking at 5,000 years of monetary history, current global trade dynamics, military buildups, industrial supply constraints, and frankly, the desperation of the entire Western financial system to keep the paper illusion from unraveling. So let's talk about where the chess pieces are on the board. Silver is literally staring at one of the most classic, powerful technical formations you could hope to see. A cup and handle pattern stretching out over roughly 15 years. Now, if you look at gold, it's already broken out from its similar pattern. It took out the top of its cup, danced into the handle, and then exploded. With silver, we're sitting right at that lip, that resistance level around $35, just begging for a breach. If it does break through, and there's every fundamental and technical reason to expect it will, you're going to watch a slingshot, because this isn't a little 12-month pattern. This is a decade and a half of base building under enormous geopolitical shifts. Now, here's where it gets fascinating and honestly infuriating. While you and I sit here watching this market grind and pop and get smacked back down, the banks have been playing a very dangerous game. And by dangerous, I don't mean for them. They'll always try to socialize the losses. I mean dangerous for the integrity of the system itself. Look at just the last month on COMEX. The commercial banks, the same banks that have had the largest concentrated short position in any commodity ever recorded on COMEX, traded nearly 500 million paper ounces in a single day to keep silver glued around $36. Then just days later, they threw another 350 million ounces of paper shorts to cap it under $37. When you tally up the open short position, you're looking at roughly 950 million ounces. That's basically a year's worth of global silver mine production sold into the market on paper. Think about how ludicrous that is. There's no actual metal behind that. Chris Marcus, who many of you know from Arcadia Economics, pointed out in a brilliant piece the other week that when these bullion banks are short on COMEX, the assumption is they're long a corresponding position in London to balance their books. But if you actually dig into the available float, the so-called free float in London, the most you could even theorize is about 7 million ounces backing this whole house of cards. 7 million. That's not even a rounding error when your paper promises are close to 1 billion ounces. If these banks aren't hedged as they pretend to be, we're staring at an existential threat to the global silver derivatives complex. Now, why is this happening? Why are these same banks so desperate to suppress silver? A lot of folks think it's just about profits, that it's about squeezing every dollar. Sure, profits matter, but this is far bigger. If you look at the military-industrial complex, the connections start becoming disturbingly obvious. Look at who's custodian for the world's largest silver ETF, SLV. It's BlackRock and JP Morgan. Same for GLD. These are the same entities with direct or indirect links all the way through to major defense contractors. I've had personal conversations that back this up. 3 years ago, I was on stage in Vancouver talking about how your average Tomahawk cruise missile has upwards of 500 ounces of silver embedded in it. Afterwards, a gentleman from the Department of Defense walked up, told me I was roughly right, and promised he'd get me better data. Never heard from him. Fast forward 2 years, same conference, same guy, this time with declassified documents in hand. Turns out it's 13 to 14 kilograms, or roughly 450 ounces, just in the tip of a cruise missile. That's one missile, folks. Now factor in drones, F-35 electronics, satellites, directed energy weapons. Silver is the irreplaceable conductor of choice. Back in 1942, the U.S. government openly legislated the requisition of all silver needed for war under Senate Bill S. 2768. At the time, we were consuming 100 million ounces annually just for the war effort, with projections up to 200 million. And that was World War II. You think our high-tech precision weapon systems today use less? Not even close. So the military-industrial complex has every incentive to keep silver cheap, plentiful, and under control. They suppress the price through naked shorting, secure the metal for industrial and military needs, and then get paid again rebuilding war-torn areas. It's a circular system of control that's functioned for decades. But here's the plot twist. This time, they're losing control. Because unlike the post-World War II period, unlike the Cold War, unlike even the early 2000s, we now have a multipolar world. The BRICS nations are eating up physical supply at record rates. China isn't just importing gold at a scale never seen before, over 200 tons in just 3 months, 5 to 10 times what they officially admit. They're also quietly vacuuming up every ounce of silver they can through indirect channels like door bars and concentrate. That circumvents the official trade numbers and makes it impossible to trace how much they truly hold. So hang tight, stack smart, and don't let the volatility or the mind games from Wall Street distract you from the big picture. That's part one. Next, we'll really roll up our sleeves and dive into how the market dynamics are likely to play out from here, why the West is cornered, and why I think we're staring down the barrel of the biggest wealth transfer any of us will see in our lifetimes.
Well, it closed. I haven't seen today's number, but it closed yesterday, June 3rd at 36.36, up $2.70 or 2.75%, rather. I'm sorry. And so, yes, this is what they do to entice the sophisticated, traders who have the ability to buy in the West and deliver in China. It will never come back. But if you're dealing in 5,000 lot increments and you're dealing in 100,000 ounces or a couple 100,000 ounces, if you're making $2-3 an ounce premium, that's a good trade. Well, it's great for your short-term trade, but in essence, you're selling out the future of the country. And that's kind of what Eric's point was, is that the Chinese understand this game. They're playing the slow, long game and have been delivering. And that's why they're buying up all the doré and the concentrate, because it masks their real endeavor, their real aspiration. And his feeling is that, and this guy lives in Hong Kong, he's spot on. And he says, look, they're playing the long game to secure enough silver, which is strategic in nature, in my mind, not industrial as we're led to believe. They're securing the future in what is really highly dependent on silver in electronics, in batteries, in military, in so many, not to mention monetary. Now, I don't know that we'll ever go back to a bimetallic system where gold and silver back the monetary system. But I do think that the realization that silver is very important, that it tracks gold regardless of its monetary status, and has since the beginning of time, those things are still in place today. So it's just beginning to be, I think, realized as something very, very important. One of the things that we've seen with gold and silver going higher is that the non-commercial interests, that would be the hedge funds in particular, have really not participated too much. And it just seems as though, looking at their participation, that it's starting to move up. So you have the central banks that have been buying, and then the non-commercial players that really haven't been too deep into gold and silver. That looks to be changing on COMEX as well. Everything is pointing towards an accentuated price into the fall. So I would say that, yesterday's move was spectacular, and we'll see if it has the follow-through to continue going. It was pretty much flat today, but it's holding. And one of the things that I've noticed with gold, and we'll see how it plays out with silver, is that anytime it gets near the 200-day moving average, there is a slew of buyers who come in and support it. When you look at gold from the context of the way that I used to view it, then again, if 3,500 was the benchmark that we finally touched and then it got slammed, it would be slammed and wouldn't come back for the next decade. It would just literally be obliterated. We'd be at 2,500 an ounce right now. If, as Rick says, past was prologue. Well, I think what we see right now is this divergence in the relationship between gold and other asset classes. Gold is taking on a life of its own, and silver will follow it. I think gold is being realized as being something where access to it is far more important than the yield that we receive on it. And that access to me is something that much of the world is saying, we don't need this to pay a yield. Getting possession of it in our hands when, we're not aligned really with the West's initiative is probably more important than not. That's why we're seeing so much of the world accumulate this stuff. But it seems to me someone within the Trump administration or some people within the Trump administration have alerted President Trump to this fact. And you can see by what's happening on COMEX and the deliveries, just how relevant people in this country, for the first time that I can remember, are viewing gold and silver. And so that's also a very bullish sign for what's coming next.
So let's pick right back up. I want to paint for you exactly how this plays out from here, because this isn't guesswork. It's math, it's market mechanics, and it's history all converging. And I'll keep hammering this point because it's the most important truth in this entire precious metals arena. Price is set on the margins by supply and demand of physical metal, not by the derivative games the West has used to control perception. When I look at COMEX right now, I see a market that's on borrowed time. And for decades, the system worked beautifully. For the banks, that is. You flood the market with paper shorts, you cap the price, you create volatility to scare out speculators, and you roll the contracts over ad infinitum. It worked because there was always a willing pool of speculators chasing leveraged returns, eager to trade contracts instead of taking delivery of bars. And there was always enough easy-to-source silver floating around the LBMA to satisfy the tiny trickle of physical demand that actually stood for delivery. But the cracks are showing. Look at the May COMEX numbers. We just saw the largest silver delivery month ever, bigger even than during the 2020 squeeze. You're talking about standing delivery requests that shocked even seasoned metals guys. And gold is seeing the same dynamic. We had $8.3 billion in gold delivered in a single month, with still hundreds of contracts open at the very end. That means shorts didn't have the metal ready to go, which forces them to scramble in the market, or pay hefty premiums to settle outside the exchange. I've been doing this a long time, and I can tell you, that is not normal market behavior. Normally, by the final notice day, you've whittled the open interest down to a handful of contracts because no one wants to take delivery. They're just there for the paper trade. But now, we're seeing month after month where hundreds of contracts are left hanging right to the wire. That's a sign of people, big money players, family offices, sovereign-connected buyers, wanting the actual metal, not a warehouse receipt. Now let me connect this back to China, because this is really where the bomb under the system sits. China has been executing a multi-decade plan to drain physical gold and silver out of the Western vaults, while simultaneously building out their own price discovery hubs. You look at the Shanghai Gold Exchange or the Shanghai Futures Exchange. These are fully deliverable markets. You have to show up with a bar or you're out. That's why delivery off Shanghai is smooth and orderly. It's how the market's designed. Meanwhile, London and New York are scrambling with 8-week settlement delays and whispers about lack of trucks. That's code for we're short metal. Eric King just posted that Chinese state-connected buyers are hoovering up every ounce of silver they can, including through opaque door and concentrate shipments. That means the official trade numbers, the ones the World Silver Survey, or LBMA, likes to cite, don't tell the real story. When China imports raw door, it doesn't show up as silver ounces. It gets refined behind closed doors, melted into kilobars, and vanishes into private or state vaults. That's metal the COMEX will never see again. Meanwhile, China is also expanding quotas for their own banks to import gold and silver. That's telling, because China isn't buying this stuff for speculation. They're buying to shore up monetary resilience, industrial security, and to be in position for a post-dollar world. Look at how they're structuring their currency swaps. Their trade agreements with Russia, Iran, Brazil, even France. They're de-dollarizing transaction by transaction and settling more and more in local currencies, but quietly backing those relationships with growing gold piles. Now here's where it ties back to Basel III. A lot of folks still underestimate how transformative these new liquidity regulations are for gold and silver. Under the Basel III Net Stable Funding Ratio, NSFR, gold in allocated physical form counts as a high-quality liquid asset, a Tier 1 reserve. Unallocated fractional metal, which is most of the LBMA and COMEX structure, is not. It's penalized on bank balance sheets. That means carrying big short positions in paper gold or silver is increasingly costly, which is why you've seen bullion banks reducing positions or even exiting the business. Even more critical, the upcoming U.S. Treasury gold audit is going to force America's hand, because the Treasury's official 8,133 tons of gold, booked at $42 an ounce on the balance sheet, is only useful for offsetting debt if it's Basel III compliant. That means they'll have to prove not only physical presence via bar audits, but clear legal title. You think that's going to pass without a hitch? I wouldn't bet on it. The inevitable revaluation to market, whether under duress or by choice, is going to unlock trillions in balance sheet maneuvering, but also blow the lid off the artificially capped price structure. And look, the LBMA can't keep selling the same bar 100 times over forever. The whole fractional reserve gold system, and it's even worse with silver, relies on no one asking for delivery all at once. But that's exactly what's happening now. The EFP, Exchange for Physical Mechanism, was their clever escape hatch. If you showed up on COMEX wanting your bar, they'd basically convert your contract to a London promise, quietly settle it over there, and you'd go away. But now London is tight too. The back door is shutting. The more China demands immediate, allocated, Basel-compliant delivery at the fixes, the more the Western paper system gets forced to cough up actual metal. That's why you see arbitrages widening and metal flowing east in torrents. It's a very dangerous game for the bullion banks, because if silver breaks above $35 decisively, that long cup and handle top, it's like opening the floodgates. Technical traders will pile in, algorithms will chase momentum, and shorts will get margin called. With a short position approaching 1 billion ounces, the unwind could be spectacular. Remember, for every short there must eventually be a buy to cover. And when the physical market is tight, that means buying at whatever price is available. So let me try to sum this up as simply as I can. The Western paper markets have been suppressing the price of gold and silver for decades, but they can't suppress the consequences. The metal has flowed east, vaults have been drained, industrial users have continued consuming, and above all, central banks have been methodically de-dollarizing into gold. And now with silver demand surging from solar, EVs, 5G, missiles, and monetary insurance buying all at once, there's no slack left in the system. And we haven't even talked about the psychology yet. Precious metals bull markets are funny creatures. They don't start with a frenzy. They start with apathy, confusion, even despair. It's only after the initial moves, after a few false starts, after the manipulators have done everything possible to discourage holders, that the real run begins. Because as the price rises, demand actually increases, the opposite of most markets. People see gold at $3,400, and instead of selling, they buy more. They see silver pushing toward $40, and instead of dumping, they scramble to secure their allocation before it's gone. That's why there's a saying, there's no bull market like a precious metals bull market. It's fear-driven, not greed-driven. People aren't buying because they want a Lambo. They're buying because they don't want to be wiped out when the financial system finally confesses it's bankrupt. That means there's almost no meaningful supply coming back onto the market when prices rise. No large above-ground stockpiles get sold down. In fact, more often than not, people just tighten their grip. The secondary market dries up exactly when new buyers arrive. That's how you get parabolic moves. So what do you do with this? Well, if you're like me, you don't treat silver like a lottery ticket. You treat it like a seat on the lifeboat. You buy it, you put it somewhere safe, and you forget about it until the storm clears. Because let me tell you, the storm is coming. The U.S. has over $34 trillion in debt, adding over $1 trillion every 90 days. The Fed's balance sheet is grotesque. Real inflation, not the CPI nonsense, is still eating 8% per year out of your savings. Meanwhile, the political willingness to tighten budgets, raise real interest rates above inflation, or let insolvent banks fail is zero. That's a one-way ticket to currency debasement. And I want to close this on a human level, because I've sat across the desk from thousands of people who thought they were diversified, thought they were safe because their broker had them in a 60-40 portfolio, 60% stocks, 40% bonds. The same safe bonds that will get obliterated by inflation or default. The same stocks priced for perpetual growth in a world choking on debt. When the realization comes that the paper promises can't all be honored, it won't matter how many shares of the S&P you own. What will matter is how much real stuff you have. Land, productive assets, energy, and yes, gold and silver. I often joke that my favorite clients are the farmers. They walk in with calloused hands, buy a bag of silver eagles or kilo bars of gold, and walk out smiling. Because they understand something most portfolio managers don't. At the end of the day, it's about tangible wealth. It's about what you can hold, what no bankrupt government or reckless central bank can print into oblivion. So folks, I'll leave you with this. Hang on tight. The system is wobbling. The banks are cornered. The manipulations are straining under the weight of physical reality. And when it snaps, not if, but when, you're going to be very, very glad you own the only assets proven across 5,000 years of history to survive every empire, every collapse, every inflation, every war. That's why I own silver. That's why I own gold. That's why I keep telling people, no matter how battered you feel by the volatility or the mainstream talking heads, stay the course. Trust your instincts, trust history, and protect your family's future. Because when this move starts in earnest, it's going to make all the frustration, all the patience, all the careful stacking worth it 1,000 times over.